Hello, good morning. And if you are watching this on the recording, thank you very much. Make sure that you skip ahead a little bit to get to the content, probably about a minute and a half or so while you get on. And while we're waiting for Facebook to do its thing, I'm going to get this shared out in a couple places. Okay, let me make sure the sound is off. That is not cool. Good morning. Good morning. All right. If you got some network marketing friends, please share this out with them. All right. I had a brain cramp, sorry. Had a slight brain cramp, but let me get this shared out in a few places and then we will get going. This is going to be some good stuff today. This question actually came from my Tax Players Club, so the answer is not cut and dry. Okay. All right. Let's get going. Okay. Thank you very much, Anthony, for the compliment. I appreciate it. Okay. So first, I want to welcome you to my show. My name is Lysandra Everett. I am the Home Biz Tax Lady. I help home business owners win the tax game by keeping more of the money they make and paying less to Uncle Sam. Okay. When you tune into my show, I'm here Monday through Friday, 9 o'clock-ish. And of course, we talk about tax topics. We talk about business and leadership and just how we do this whole thing called Life Better Together. I am about building legacy wealth for our families. And that's what I'm about. Okay, so today's topic is actually a carryover from a Facebook Live I did last week. Last week, I shared a case where the IRS, the local tax court, ruled against the network marketer. And what do I mean? Well, the network marketer was claiming a home business, but the IRS said, no, you have a hobby. And what that means is that the IRS then disallowed a lot of their deductions. Now that couple actually is going to have to pay money back to the IRS. The case did not say exactly how much they were going to have to pay back, but they're going to have to pay some money back. So one of the follow-up questions to that was, about the being in profit 3 out of 5 years. Okay. The question to that was, well, when does that 3 out of 5 years start? Okay. Good morning. Good morning. So what I wanted to share with you this morning is really give you some insight on how the IRS reviews your business. Like, what are they looking at to say, yes, you're a business and no, you're not. Okay. So first, let me address the being in business, being in profit 3 out of 5 years. So when you first get started in business, right? The IRS expects you to have startup costs. Every business has a startup cost. Okay. I don't care what you're doing. Even on, you see these business opportunities online, say, free to join. Okay, you're going to have some costs. Let me tell you that. Okay. So when you're first getting started in business, the IRS expects you to operate at a loss. You're going to invest in different types of things. You might be investing in product. You might be investing in, the things required for you to form a business entity, whatever. You're going to spend money forming a business before you actually sell anything. Okay. That's just the way business works. So the IRS is looking at you. Hey, good morning. Good morning. Hey, Daryl, long time no see, buddy. So the IRS expects you to lose money in the beginning. Okay. That's just life. Now, so in your first year filing your tax return, you operated at a loss. Okay. The second year you operated at a loss. Okay. But that third year, the IRS is going, wait a minute. And let me explain to you why. Because most, especially when it comes down to network marketing, most people are filing a Schedule C, and the income or loss from your Schedule C, if you're operating at a loss, it offsets any type of W-2 income, okay? So that means is that if you claim a loss of, let's say, $5,000 in your business, right? That loss carries over to your other income and reduces your, it reduces your taxable income, okay? So that's how that loss on paper affects your income. And so after a while, that's going to make the IRS perk up, because they're saying, okay, are you really in business, or are you really just trying to pimp the business to reduce your income? In the case I shared last week, this couple was, they had a 6-figure income, but they were also posting 5-figure losses. So they're reducing that taxable income, and they posted losses for years. Okay. So it wasn't just the IRS said, okay, here's your number 3, you're at a loss. No, this was over about 5 or 6 years. They were posting these losses. And the more their income went up, the more their losses went up to reduce that taxable income. Okay. So that's why I want to talk about exactly what the IRS is looking at when they say no. Okay. If they say no, you do not have a business, you have a hobby, and no, you cannot claim all of these deductions. All right. So the first thing is there the time and effort put into the activity to indicate an intent to make a profit? So when you're talking about how do you justify, how do you support, how do you provide evidence that you are actually putting in the time required? Okay, so this is where your calendar comes in. This is where you go and look on your calendar and said, okay, I've met with Larry, Curly, Mo, Sue, whatever on such and such day. They're looking at your activity. Does your activity indicate that you intend to make a profit? If you're only meeting with one person a week, and you're meeting with the same person over and over again, and you're not making any sales, that is not an intent to make a profit. Okay. No. So you have to have documentation to support your deductions, to support your time. Okay. That's why your calendar is important. All right. Let me check these off. All right. Next one, does the taxpayer depend on the income from the activity? Now, as your business grows, if you are really in business to be in business, you are trying to generate an income for you to live off of. Okay. So if you are continually operating at a loss, then you can't be depending on losing $25,000 a year. Okay. Who does that? Nobody, because that is not sustainable. All right. So if you are not increasing your income over time, then you're not depending on this income for your livelihood. The IRS is going to tell you, no, you are not in business for yourself. You have a hobby. Okay. Now, the losses, are the losses due to circumstances beyond the taxpayer's control, or did they occur in the startup phase of business? Okay. This is where the 3 out of 5 years is important. Okay. Because in the startup phase, the IRS expects you to lose money because you have to invest before you even sell anything. Okay. Even if you just buying business cards, you still got to invest before you actually sell anything. All right. And so, are the losses due to anything, beyond your control? Like when the whole real estate thing happened, right? There are a lot of people that felt the sting of when the real estate market went kaplooey, right? So or you might be in an area where a natural disaster occurred. Okay, well, not much business is going to be going on if if your town had a tornado, right? There's not going to be a whole lot going on. So you might have that issue where it causes a loss of your revenue, of your income. All right. So that is what they mean when they're saying beyond beyond your control. You can't control if a tornado comes through and wipes out your entire town, right? Okay. The next thing, Has the taxpayer changed methods of operation to improve profitability? Okay, so if you know that sitting behind your computer chatting on Facebook isn't working to build your business, what are you going to do differently? Did you decide, okay, maybe I need to go join a networking group, or perhaps I need to go and meet people and increase my network? All right. The IRS is looking at if you're doing the same thing over and over again and getting the same result, which is a loss. Are you doing anything different? If you're not, the IRS says, no, you have a hobby. All right. They look at, have you made a profit in a similar activities in the past? Okay, so here we go. So for all of my network marketing company hoppers, okay, if you continually start network marketing businesses and you continue operating at a loss, the IRS is going to disallow those deductions, okay? So it's not that you are in this opportunity and failed, and then this opportunity and failed, and then this opportunity and failed. The IRS is going, no. You cannot be a serial network marketing opportunity hopper when this is it's the same industry, okay? So if you have continually failed at this industry and you think you're gonna keep, joining new companies and claiming new losses, the IRS says, no, we're not that stupid. So they're looking at your history. So that's what I'm saying. It might not be, at that third year you're claiming a loss and then the IRS goes, yeah, no. They're looking at a longer period of time. So they might not catch you in that third year. They might look at you in maybe year 6, like they did this couple, and say, okay, no, this is opportunity hopping here, and this is not going to work out. All right. So that's normal. Does the activity make profit in some years? Now, again, they're looking over a longer period of time. So it's not like the IRS says, okay, here's year 3 and, you're in trouble. Right, girl? Who wants a loss? We do need this money, girl. Okay. So does the business make profit in some years? Every business goes through some turmoil, okay? So the IRS is not looking and saying, okay, well, here you had this loss this year. Okay, no, we're not going to allow you to take deductions. They're going to look at the whole, at the whole big picture, okay? So again, like if you have a natural disaster that sweeps through your town and knocks all of your business out, you're going to be at a loss. But have you made some profit before? Okay, this might be a bad year for real estate. Okay, it might be a buyer's market and not a whole lot of sellers are selling. Okay, it might be that, everybody's plumbing is working just fine and they have no need for you. Okay, so this is what I'm saying, and that they're looking at the big picture. Have you been making profit in some years? Okay, so it's not just that first 3 years. They're looking at at a longer period. All right. Now, can the taxpayer expect to make a profit in the future from the appreciation of assets used in the activity? Okay. So, so again, what are you, it depends on what you're selling. If what you're selling is going to appreciate, then you might make more money in the future. All right. So, so the thing about it is this: when we're talking about profit and loss in a business, first of all, your business structure is going to matter. For those that are sole proprietors or single member LLCs, or even in an S corp, okay, your income is going to pass through to your 1040, because even in an S corp, okay, you have to pay yourself. You have to pay yourself in an S corp, and you're also going to have dividends. Okay, an LLC is a Schedule C. That income or loss is going to pass through. Partnerships are the same thing. There's a K1 that passes through to your 1040, profit or loss. Okay, so so those pass-through entities is what they're called. Those pass-through entities, meaning that your money from your business passes through to your 1040. If that is going to reduce your taxable income, then that's going to raise a red flag to the IRS. Okay, so it doesn't matter when the clock starts from the time you filed that first tax return. Okay. That's when the clock starts. Now, let's say you zero out. If you zero out, fine. Okay. It's the loss that matters, because the IRS is saying if you're continually losing, $12,000 a year, how are you still living? What are you doing? How is this even possible? Let me give you an example. I had a client come to me. He actually sold stuff at, he did flea markets, right? So he would go to different flea markets and he would sell his wares there. But here's the thing. He had an unscrupulous tax preparer who guaranteed him a tax refund. Any tax preparer that guarantees you a tax refund is a liar if they have not even looked at what you have. All right. No, nobody can guarantee you a tax refund. So that's a red flag that you definitely need to look out for. Okay. But what happened is, in order for him to get a tax refund, this tax preparer showed him at extraordinary losses. At one year, it was like $17,000. The year before that was $11,000. The year before that, it was, like $10,000. It was something crazy. So at that third year, the IRS sent him a mail audit to say, hey, we'd like to see documentation of these expenses, right? And then therein lied the problem, because he did not have documentation for the expenses, because he didn't even know what this tax preparer did on his taxes. So what happened is, so not only did he have to pay back the refund that he got, he also owed taxes. And so with that, he owed taxes from the time the tax was due, plus the penalties and the interest. All right. So if the IRS goes back and disallows your tax deductions, guess what? You're going to have to pay some money back. All right. This is nothing to play with. So, I can beat this horse to death. All right. But I really wanted to come on here and really help you understand exactly what the IRS is looking at. It's not just one little thing. Yeah, the profit thing, being in profit 3 out of 5 years, that's the first thing that throws up the red flag. But that's something that puts you on the IRS radar. And so then if you come back year 4, year 5, year 6, and you're still showing these losses, that's when the IRS is going to come for you and say, excuse me, can we see your documentation? Now, if you, especially as a network marketer, okay, if you can show on your calendar that, hey, I'm here giving out samples to 15 people, and here are their names, here are their phone numbers, and all of that, okay, then you are substantiating that you are spending your time trying to build your business. This is how samples, listen, for my network marketers, this is how samples are powerful for you. Okay, because if you give out a sample, you don't just randomly give out samples on the street. You need a name and a phone number, and you need to follow up with these people, because here's what's going to happen. If you've got in your calendar that on July 31st that I gave Lorvell a sample of, water, right? If I'm selling water, I gave him a sample of water. I've got his name and phone number here, so I can call and follow up with him. Now, when the IRS, get this, if the IRS comes to audit you, they can flip through your calendar and say, okay, we're going to call Mr. Lorvell. Hello, Mr. Lorvell. This is the IRS speaking. Yes, on July 31st, Lysandra said that she gave you a sample of water. Has she followed up with you? Now, if Lorvell turns around and say, who? I've never got a sample of water from anybody. Boom, disallowed, okay? Because the IRS, they will tell you who they're going to call. They have to tell you that, but trust and believe they will call, okay? That's how this works. So if your business entity is one that is separate, that it does not affect any other W-2 income, that it doesn't offset, this is not that big a deal, okay? But when your losses are reducing your taxable income somewhere else, yes, the IRS is going to pay attention. All right. So Woo! That was a lot. But I want to make sure that I want to check and make sure if anybody have any questions before I jump off here. I just want to make sure this is clear. Okay. Anyone that have any questions? And thank you for all of those who shared. I certainly do appreciate you, because I want to get this out there, because here's the deal. I've got too many network marketers who are in trouble with the IRS over this tax thing. All right. And here's the other thing that came out of that case as well. One of the things that came out in the case that I shared last week is, did the distributor seek the advice of someone other than the person that has a financial interest in what you're doing? That whole my upline said is not a defense with the IRS, because your upline has a financial interest in you staying with the company, buying products and all of that stuff. Okay, so nuts and bolts is they're asking, did you go talk to a business coach that's got nothing to do with your network marketing company? Did you talk to a tax professional? Did you talk to a CPA? Did you talk to anybody that knows anything about business other than your upline? Did you have a business plan? Okay, here's the other thing, all right? The other thing that came out of this case, where the network marketer said, they asked, did you have a business plan? They didn't have a business plan. What do they have? They have their business compensation plan that shows, how much you can make. No, that is not a business plan. The business plan is what you plan to do to earn income in your business. Okay. All right. So now I am going to be quiet. I am off this soapbox. All right, you guys, I got to run. I really hope you got some good information out of this. Listen, this is very near and dear to my heart. I come from the home business industry. I get it. Okay. That's why I'm here, to help keep us in right standing with the IRS. Okay. So listen, that's it for me. I got to run, you guys. Thanks so much for tuning in, and I will see you next time. All right. Bye. All right. There we go.